Okay, so what is it, a Thursday? Oh, over here. Thursday, the 16th of August, 2018. Whoa. This is your daily Forex trading strategies session. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne. I'm the Chief FX Market Strategist for TradersWay.com. That means you and I get together and we analyze the market together, both technically and fundamentally, and try to come up with a trade plan that suits your point of view. I don't know if you're a bull or a bear, but we go through the market, looking at the market from the point of view of a bull or a bear, and then try to put together logical, intelligent trade plans based on macroeconomics, central banking policy, long-term technicals, medium-term technicals, and short-term technicals. Put it all together into a strategic plan, and if you can tactically carry out that plan, yeah, you just might survive. Now, the overriding goal is to teach you how to be successful as an independently thinking and capable currency trader. Either you trade your own money into giant sums over the long run, as we discussed, that could be 5 or 10 years. Or you decide you want to trade other people's money. That's cool too. But we want you to live out and achieve your dreams and then develop new ones because of the success you found here. And TradersWay would like to be your trading partner. Hey, PJ, you and I didn't follow up with each other yesterday, and I was supposed to follow up with someone else, and so when I say we need to follow up, that means you need to follow up with me. You know what I'm talking about? Yeah. So yeah, follow up with me and let's get you taken care of. So anyways, I'm super excited to be here yet another day. Morning, David. Yeah, we means you. At least it does for my wife. All right, there we go. But usually when that comes up, it's like she has been doing 10,000 things all day while I have done nothing. And then she says, yo, perhaps you should help. By help, she means she's not going to do any more, and I have to do the rest. Yeah, okay, that makes sense. Just I'm multitasker. I can't multitask anything. So anyways, let's get going. Happy to be here, folks. Let's rip through the charts. Let's just start where WTI. Life is fair like my hair. Yeah. This is where we left off, and really nothing's changed on this chart for about a week. And let's try to get my drawing tool to work here. Let's get the colors to print properly. There you go. Usually. All right. So our trade plan was one of two things. We would use this as support as a bull. Again, you don't have to be a bull. I'm just, if you were a bull, this area here would be obvious support. First of all, it's an S1 pivot. It's not the world's greatest pivot, but you're going to jam that into your analysis. Why wouldn't you, right? Roll reversals here and all that kind of stuff. And what we predicted, and in fact, we did this last week, right? Probably Wednesday of last week, so more than a week ago. And we did get a retouch, and we did get a higher high, which was even gooder. I mean, at this point, we were expecting to move up. This one, we got it. But it's not on the right pivot. If you're a swing trader, you know that. You're like, wait, that's not the right pivot. That means your expectations for this would only be up to here. You look at that and you're like, okay, I'm fine with that. So the next step on, was it yesterday or Tuesday, or I guess late Tuesday? I guess it's Wednesday London session. Anyways, we were hoping for a retracement, which we got, and then an extension, which we didn't got. And all of a sudden, we're way back here, right? Boo-hoo. Well, don't cry for me, Argentina, because our plan B from probably 3 weeks ago was, if that don't work, none, as they say in Georgia. Let me change colors, right? If this don't work, none, you certainly had an opportunity to make money or break even. I mean, it didn't work out. So what? Why you cry about that? What it should have done is this, right? It should have, if it came down, it should have come down here or kicked off this pivot. So it should have been a 382 or a 618 if you were a bull. Both of those would have been fine. And it didn't work out, but that's why they invented stop losses, right? And now plan B, which we've known for weeks, is in here. This would be a place where a bull would look for a bullish entry. Now, there's all of this kind of stuff. It's all previous support if you look this way. So it's all good for all those reasons. But also, this is the target for everyone that shorted here, which was also a fantastic opportunity on Monday morning. To me, it's actually Sunday afternoon. But to have taken that, well, A, you have to be a bear, and B, you would have had to survive this, and that wouldn't have been that easy to survive. But your stop was supposed to be there. But after that, I'm pretty sure you would have jammed your stop at break even, which would have been about here. But nonetheless, anyone that sold here or sold here, anyone that had a longer kind of view, this is the target. So the theory is yesterday, my trades seem to go. This is where bears should have gotten out. Okay. Any bear that's still in the trade doesn't know how to swing trade on a weekly basis, which means they don't know how to swing on a monthly basis either. Okay. But that's what that should be. This is where shorter term swing traders should take their profit and run if they happen to be a bear. This is the lower low, lower high, lower low. Take your money off the table and run. Cool, right on. Send another one. If you needed something from me, send another email. Oh, yeah. It's just the one video. It's jacked up like 3,000%. Wear a headset, bro. That'll help. Yeah, well, I can't, I've already jacked it up 300%. It's just a bad sound. It was a glitch, but it's the one, it's only the one. No. He's talking about a video in the swing trading course. One of them, for some reason, there was a mic error. So. All right, so that's sort of that, right? So let's put a ribbon on this. This is still viable. Oh, there you go. Yeah, John's got an interesting. Yeah, interesting. Yeah, so we'll get to the end. Faux show. Okay. Yeah, well, like I said, I know a sound sculpturist. You know, like when you meet people at a party, like what do? This dude says he builds sound sculptures. And I said, "Are you high right now?" Like, thank God, because society totally needs sound sculptures. Sculptures you can't see. Need it. I should have said, you know what? Holy snap! Me too! Oh, well, I'm setting up an Atmos system, John, and my brain is going nuts because I can't get it right. And everyone's like, that was a great movie. I'm like, I can't stand sitting in the state of sound like that. So, but anyways, you could help me, I'm sure. So anyways, yeah, if you wanted to be a bull, the funny thing is, I mean, we got to go back in history just to remind ourselves, right? Oh, yeah, used to, yeah, home theater systems. I don't have the best system in the world, obviously, but I did get carbon fiber, liquid cooled system, and that's enough to make my spider senses tingle. So this was the plan. I kid you not, like in May. Okay, isn't that cool? So we are now. I mean, we have to go back and talk about this. This is what we talked about in May, and that this should or could potentially at some point set up a head and shoulders. But then on top of that analysis, because that's just a head and shoulders, I don't actually expect this to decline, but we did talk about the setup. So to add to that, what we discussed in May, is it would set up like this, just like a head and shoulders, except it won't fulfill the head and shoulders. And my thought, my hopes, my dreams is either here or here, of course, because you have to adjust for current market conditions, somewhere in this zone, which now makes it a crown, not a head and shoulders, but I think we even talked about that, that it would rise and then probably fall and then rise again. I'm still in the camp that, on the long run, we should be moving to 80, not, let's say not 80, not 40. Not 40 is too low. 50? Well, that could happen, right? That could happen, but I'm going to say here, as far as this sort of move here, if we get lower than that, I might obviously adjust. But I'm thinking we're more likely to head this way than towards 50. Okay? Do I know I'm right? No, of course. Do I have information to back that up? Yeah, I probably could. I don't have it for you now, but if I had to, I could. So that's just sort of my bias, right? I'm hoping, my hypothesis is things are better in the world than they are worse. In those situations, eventually, when summer's over, we'll do this. Now, moving to 80, let's say we do go to 80, that could, I don't know, that could take 6 months, let's say. Like, I don't mean quick, but more importantly to that sort of thought process, or dare I even call it analysis, but is that this should be the bottom. Like, I might hang on to the filthy, stinking dog with fleas hypotheses down to 61, 65. But any lower than that, foobar. I have to come up with a whole new plan. Okay? So it's sort of like the here and now, right? Like it can go down here. I'd rather just say, you know what? Let's tickle off the M1 and then rock it the other way. That's what I'm hoping for. And that also fits into my swing trade, like my position trade, right? For everyone that's going to take a swing trading, well, not the swing trading course, but finish the swing trading course and join the swing trading group, we're not actually really, truly, probably going to swing trade per se between now and the end of the year. We're going to position trade, which is a portfolio manager type thing, right? Which means you have to have strategy and then tactics and all that kind of stuff. So it is a slightly different beast. And all of this kind of fits into it, because if we get into here and then make a macro move up for the rest of the year, that's going to be important to multiple currencies for multiple reasons. Like a rise in CAD, absolutely. But it's not just oil for CAD. I bet you if oil went up, let's say gold would go up a bit, but gold is its own beast. But wheat and barley and beef and nickel and copper and all that kind of stuff would also go up. Why? The general theme of improving macroeconomic conditions. Okay, Brooke asks a pretty interesting fundamental question, right? If oil goes up, that's inflation, and US dollar goes up, that's deflation. Won't that be bad for the global economy? Well, the dollar going up for the United States is bad because it hurts their exports, but it's great for imports. So think of it that way. Like when the president of the United States is complaining that, Boeing can't sell airplanes, I'm like, okay, but I can go to I can go to where do people go to buy stuff? Best Buy. I go to Best Buy and TVs are cheap. And then I go to the grocery store and wine is cheap. And why? Well, because my dollar is strong. Aha! So I'm not going to buy a Boeing plane anytime soon, right? But other things tend to be cheaper. So but see, that's deflationary because I'm buying bigger and better stuff for less and less quantities of US dollar. So that is deflationary, right? But so where does the inflation go? Well, John, Brent and WTI are somewhat linked by global macro. The spread has to do with the cost of pulling it out of the North Sea versus sucking it out of the desert. There's a difference, right? Because, well, there's a mile of water, on top of the desert. Right? Yeah, so there's a spread. What does it cost to get oil through a mile of salty water? $10. Yeah, Guy brings up an interesting point too. But anyways, going back to what Brooke was talking about, foreign countries, especially emerging market countries, borrow a lot of money in dollar terms. And so when the dollar goes up, it's like your mortgage going up. Okay? And when you're poor and you bought a house way too big relative to your income, if your mortgage goes up, let's say 8% a month, you're like, you were already tapped out. So that's kind of the problem with Turkey and a lot of other countries. So here's what Turkey is supposed to do: jack up interest rates because they borrowed a bunch of money. Now they can't afford to pay it back. So now they have the inflation. The United States used to have inflation, but the United States exports inflation. That's why we don't have any inflation here, and haven't had it since the let's say 1980. There hasn't been any inflation here. It's all gone away. Well, where did it go? Overseas. We exported it. So a country like Turkey is supposed to jack up interest rates now because the dollar's going up and their currency is weakening. So great, raise interest rates, because a weakening currency creates inflation. So the United States has a strong dollar. We don't have an inflation. There's no inflation here. So it goes to Turkey. Turkey has inflation. They're supposed to jack up interest rates. But they're not. That's it. It's over. Done. Ish kaputya. Okay. So the problem is the Fed will raise interest rates again and again and again and again. So Turkey's in serious trouble because it's going to get worse and worse and worse and worse and worse. Well, not the country, the economy. There's still going to be Turkish people. Gee whiz. But, Turkey's going to get poor really fast. Here's what I talked about with my wife while we were walking my dog. I said, yeah, there's going to be a surprise. I don't really know when it'll be. It should be like within a month, but Turkey's not doing their job. Okay? But if the central bank truly was independent, here's what would happen. There will be a surprise. I said, it should be within a month. It really should be within a week, but it really should be within a month, but I bet you it'll take them 3 months. But because things need to get even worse than a 30% decline, right? But let me spit it out here. I said, I think that Turkey is just going to come out one day, just boom, raise interest rates at least 25%. At least. It should be 40 or 50%. But the problem is the regime running the country and taking over the central bank. They're doing their form of quantitative easing, which may not be a good form of quantitative easing. But nonetheless, they're doing their own version of quantitative easing, and it may not work out. I don't know. We'll see, right? I did talk about 5 or 6 years ago, some emerging economy was going to say, hey, we're going to do our own version and we're going to do it 10 times better, which could lead to utter total collapse. But, okay. Yeah. Yeah, Erdogan doesn't want to do it. But so here's what should happen. Like I said, all of a sudden, Turkey will announce they raised by 30%. 30%, not 3%. 30. So all of a sudden they'll have 45 or 50% interest rates. Yeah, that's what should happen. But yeah, no, that's called nepotism. Google it. All right. Yeah. So we're looking at this line in the sand for something interesting, and we're looking for an up. This was a sell, wasn't it? Let's go back. Oh yeah, bears had remember it was rallying up. I guess it was Monday or something. I don't know. So yeah, so Monday we had it rallying up, and I said, no. A bear would sell this, right? Look, I even put a red line. I put a gray box. That's going above and beyond, I think. And then I drew it here, right? So I said, no. This is going up, but a bear would sell this. And then they would sell this if it went up that high, right? Morning, Deej. Right? So, did that work out? Dude, you work out? Was it 30 pips? Is that right? 80, 80. No, it's 100 pips. 110 pips. Could have made money on that, right? Coulda, shoulda, woulda. This is setting up, if you're a bull now, remember, I'm expecting maybe, sometime soon, in the next 4 weeks, in the next 6 weeks, there you go, right? That doesn't tell me timing. In the next 6 weeks, I expect this to go up. Okay, 79, 70. Yeah. Okay, yeah. Okay, sometime in the near future, I would like this to go up. Now, this line in the sand is moderately important to me, but it's an S1 on a weekly, so it's what we call a WS1. And I'm like, meh, but I like the fact that it's support. Because it means bears were supposed to take this even further south, and they couldn't even do that. That means a lot of bears took profit in this area. Is there any reason why, let's say, half the bears took profit so that they couldn't even get to their weekly target? Well, first of all, this trade plan is last week's trade plan. So a lot of traders were supposed to get out in this area, which I would venture to guess they did. And then Monday opened out a position, which is also a, uh-oh, you're going to hit your target early, right, kind of thing. So more probably gapped out, right? Hitting an S1, probably more people jam their stops, so then even more, right? And then, of course, the monthly M1 is here. Ah, ay caramba. That is the conservative target for the month of August. So anyone, a lot of traders got out here. Some people got gapped out here, got the M1, combined it with the S1, and they're like, good enough for the girls I go with, so they take some profit there. Everyone else doesn't know what's going on, and they're hoping and praying and all this kind of stuff. And it comes down to here. Now, what's significant about that price? Monthly S2. That is the target. That is the target. Yes, it's also a weekly in there too. I'll throw in the weekly, but I don't care anymore about the weekly. But weekly M1. All right, sure, fine, good. Fine, cool. But it way significantly more important is monthly S2. Because we talked about that 2.5 weeks ago, that's supposed to be the bottom for the month of August. Isn't that neat? Don't you think that's neat? Where we could say 2.5 weeks ago, you're like, yeah, somewhere around 79, 70 should be the bottom. And it was this number right there. Like, what? That's neat, right? 2.5 weeks ago, you can say that's going to be the bottom. I think it's super neat. John, no, I disagree. I humbly disagree. I go monthly, then I go weekly, and then I go daily. So it's like this, and then the weeklies, and then the dailies on the right. So the weekly is in there too, and it only makes the monthly that much more important. Okay. What you'll find in certain situations is like the weekly here failed. I call this an Arctic turtle, where the turtle is stuck in a shell, which is sort of the weekly basis, but he sees the fruit. And in the fruit, let me change colors for the juicy fruit. The fruit's over here. Okay? So the trader stretches his neck out to get the fruit. What happens? Well, first of all, an Arctic turtle is very, very, very slow, even for a turtle, because they're cold. I know, a stupid name, right? And the Arctic turtle sticks his neck out to get to the fruit. And what happens to the turtle? Chop! Someone chops off his neck because he's too slow to react. He's vulnerable, right? And that's where you start to see reversals. Okay? And what it is it's traders sort of stretching into the next trade, and they're nervous about it, obviously, and they take their profits, right? So I stack these things. So if there's a weekly just slightly above a monthly, I still think monthly. If the weekly is just below the monthly, I'll go with the weekly, but you still got to be concerned. Like, it could do this now and then pop. And the reason it does this is not everybody knows the monthly. So what they'll do is they'll get out here, but everyone else is already out. So that it's like sort of like the reversal I just discussed. Significant amount of traders are going to take their profit here, which means much of the time the market just reverses, and it reverses at an S1 because there wasn't enough weekly traders to get down to the M1 like they hoped for, or even S2, right? There's just wasn't enough weekly traders left to get to the weekly S2 because the bigger traders using the monthly pivots took their profits and ran because they hit their monthlies. I mean, first of all, John, that's your observation, so I can't say you're wrong. What I would say is I think the monthly is more important, and the weekly sort of fits in there, and you get sort of a noise around it, right? Ultimately, this is the target. It doesn't mean you can't dip below, but the thing is, if you dip below, it's going to pop back up pretty quick. Okay? Because significant amounts took profit here because they are using the monthlies. And then these guys will get in, they'll get out. And just because everyone's out, the market will reverse, right? Another way of looking at it, John, and I think this should be helpful for a lot of people, it's where my trade planning starts, okay? This is a bearish, oops, didn't draw it right. Delete, try it again. Delete. Okay, this is a sell zone for the month of August. Okay, if I sold there, what's my target? M1 is conservative, MM1 is conservative. What's the aggressive target? Monthly S2, MS2. That was the assumption on August 1st. Okay? Can you see how that could completely overtake my focus for the month? I could just start with that. I could say, I'm a bear and we're going down to the target. Okay? So I get that in. That takes over strategy. I know what to do. I know where we're going. Now, I don't know if we're actually getting there, but it's a strategy. I know what I want to do. I know where I want to go. I know where I would take profit. Okay? So it takes over everything. Then I drop into a smaller time frame, and then you do weekly trades. This price here predicts this move here. So that takes over, but I would have already made this decision, right? So this is where we're going for the month. So how does a trend move like 400 pips? Well, you got to go down, 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 up, up, sell, down, 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 up, up, sell, down, 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 or something to that effect. So on a monthly basis, I already have this in mind. And I already have the price action in mind. Because I know it's got to fall. Where's it going to fall to? The next level of support. Then what is it going to do? It's going to bounce. So what do you do with the retracement? Sell high at somewhere between the 382, 618 on a pivot point, on a cycle level, on price action. But you already know it's going to fall because that's your trade plan. Then it's going to hit support. Then it's going to rally up and you're going to sell that. And then it's going to fall and make a lower low. Great. Hit support. Great. Retrace. Great. Roll reversal. Great. Sell the heck out of that. Boom. And you keep doing that until you get here. So now you're folding your weeklies into that. And then ideally, John, right? Then you're also folding in your dailies, right? So this could be like a Monday. This retracement could be a Tuesday. This extension could be a Wednesday. This retracement could be a Thursday. And this drop could be a Friday. Or something thereof. So you go back to this, you're like, oh yeah, I'm going to sell the M3. You see how like you're not even debating? Right? Newer traders, they debate so much, they're like master debaters, right? And then after a while they get sick of it because they can't make a decision, so then they just try everything and nothing at all. Wandering in hopeless night. Let me tell you about heartache and the loss of God. Wandering in hopeless night. Yeah. So then you fold the weeklies in, right? And so going to here, this was the sell zone for this week, and this was the target for this week. Down here, just slightly low. Okay. Notice something. We opened out a position. Swing traders know. 4-hour 21. 4-hour 21 gets you down into here. Should do it quickly. When it does it too quickly, you're going to counter trend. And if you get a counter trend set up in the middle of your monthly, take the profit run, son, because it's going to reverse. Why? Because it's supposed to. And why does it actually supposed to? Because everyone that shorted here, and then ultimately would have been this, just took profit and walked away. And everyone else is like, please fall further, please. Or they'll say, oh, thank goodness, now that it's fallen for 2.5 weeks straight, it's going to keep falling. And of course, then they sell low at monthly and weekly support and they lose their money. And they're like, well, I think I need to try the ADX and the CCI. Yeah, John. So, John, but I hope that helps because you can never be wrong by saying, well, I use weekly pivot points, right? Totally awesome. But then there has to be something that supersedes that. So what I would like for everyone to do, and this is what I keep coaching, is that on the first day of the month, you're like, oh, I have a strategy for the month. Does anyone here lack strategy for the month? Like, you don't say, like, in September, I'm going to be long yens. Yeah. I'm telling you, even if you're wrong, trading is so much easier, not necessarily easier to profit, or you won't necessarily make more money. Shoot, you can lose money, right? If you ain't first, you're last. Hell, you can be second, third. You can even be fourth, right? But the thing is, knowing what you're going to do before you do it, even if you're wrong, will dramatically improve your trading. Well, and David says, or a few days before the month. Yeah, well, and that's what I'm teaching in the swing trading course, right? To be able to do that analysis and then even front run. That's why a lot of these setups you'll see are actually, because if you go back, this was actually the sell. It wasn't August 1st, right? It was somewhere else, or no, actually it was a different pair, so I'll take that back. But anyways, yeah, we're front running, right? But it's so much more helpful to say, okay, for the next several weeks, I think this is going to happen. Okay? You see what I mean? You start with that in mind. And you're like, well, how do I get there? Well, that's what technical analysis is, right? Or you could totally disagree with that. It doesn't bother me. This could have been your plan. This was beautiful, by the way. If this was your plan, you had beautiful opportunities to carry this out. Okay? You would have bought in here for show. Faux show! It was beautiful. You probably didn't lose any money. You might have made money on that rally. But I think non-farm payrolls was in there or something, right? But whatever. No, NFP was in here. So yeah, you maybe made money here. I doubt it. You would have hung on. But I don't think you lost money. You were wrong. And I don't think you lost money on that. That was beautiful. That was simpleton kindergarten stuff. And your plan was up, 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 up. Great. Didn't work out. Sorry. But you had an opportunity. You had a strategy. You had the tactical entry. And you didn't lose money. You get to survive to fight another day. When's another day for you? September? Because that's a monthly plan. Okay? Like, to show you, this was a buy zone for bulls. So you even had two chances. Oops, I wanted that to be black, but well, let's do it this way. You had come on, change color. You had this one, then you had this one. Both went up, I don't know, 50 pips or more. And then you found out you were wrong. Huh. Well, that's August for you. You had the entries. The strategy was there. You had the entries. You took the shot. You had the opportunity. You didn't lose money. One and done and on to the next one, right? Maybe you'll do better in September. And obviously, you got to readjust your shorter-term trade plans. Okay. So then you could say, well, I got my strategy wrong, so I got to be tactical now the rest of the month. And so now maybe you only use weeklies. Now you maybe only use dailies because you're like, well, I think this is misaligned. You know what I mean? You can say, I think this is misaligned. You wanted this to go up. You think fundamentally it should go up, but for some reason in August, we're way down here. And you're like, oh. Well, where would the next opportunity be? Well, if you know you're wrong on a monthly basis, what do you do when you hit the bearish monthly target? Well, you're a bull. But you should be able to figure out what the bear's target is. You know what I mean? Even though you're not a bear, you can say, well, I know where the bears are going. I know where they're taking this. And you get down here on the 13th of the month or the 14th of the month or the 15th of the month, you have permission to consider maybe, possibly, if you want to, counter trend trading. And why is that? Because all these people were supposed to get out of the trade. Well, that could be bullish for you if you're already a bull, and so now you start tiptoeing into a counter trend trade. Doesn't mean it's going to work. Doesn't mean it's going to go up forever like you hoped over here, but it's something, right? Do you know what I'm talking about? And this line here says, get out. And this line here says, get out. So what do you think the bears are likely to do here? Just try to predict the future. I don't know what the future is. I don't know what these people are going to do. I don't know what their strategy is. I don't know what their plan is. I don't know what how tall they are, what car they drive, how long their commute is, if any. Predict the future. What do you think could possibly happen there? Or probably happen? Type in a question mark if you just don't know. You just really don't know the truth. No, simpler than that. If the red line says get out and the blue line says get out, what do you think could possibly happen between those two lines? Whoever's short will probably get out. But are you doing that level of analysis? Where you're looking at it, you're like, oh, that's definitely a place where they're going to get out. So now I'm going to drop down into a small time frame. I'm going to look for reversal patterns, and I'm going to drop a lot and pop a stop, or pop a lot and drop a stop, I guess it is. Well, don't get that confused with other traders going long. Bilal says, they would probably get it. Well, I don't think institutional traders think that way. Like, let's drop $1 billion on Aussie yen, and then they wake up, they're like, oh boy, look at the price we're at. Let's cash out of the $1 billion, and then let's go the other way with $1 billion. Okay? More strategically, because remember, why do hedge funds get money? Why do people give money to hedge funds? Well, if they're short Aussie yen, they're worried about the yen getting strong and the Aussie getting weak. They're hedging. So they're not necessarily long and short, long, short, long, all that kind of stuff, right? Now, David says returns. Well, in that case, absolute return. There's a difference. Absolute returns are not benchmark. So I listened to an interview recently with a hedge fund manager who's retiring now, and he's giving away many billions of personal wealth to charity. He said his car is like 18 years old. He says, like, I don't collect art. I don't own a yacht. My car is 18 years old. He's like, I'm a simple guy. So I'm giving away $8 billion in cash. It's like, why not? But he said the major reason to retire, because he's like 77, still making huge sums of money, right? Well, one of the major reasons is he's just like, I want to be unchained from the S&P 500. He just wants to walk away from, because when you have a long short equity fund where you're trading stocks, you're a stock picker, you have to beat the S&P 500. Okay. Plus, you're probably charging 30%. So after you get paid your 30% or your 20% or whatever it is. You have to, the client has to do significantly better than what he could have got or she could have got by just investing into the S&P 500. And even then, that has to be adjusted for risk. So if you're taking a lot of leverage, you should have a lot of return, even if you're beating the S&P 500 by, let's say, 10%, but you're 100 to 1 leveraged. Well, then you should beat it by 100, not by 10. And then they would say, well, that's too much risk. I don't want that. That's why you look at risk adjusted, right? So an absolute return fund, like a foreign exchange fund, should make money if the market's going up or down, and there is no benchmark. There might be beta. You can consider beta a benchmark. That gets complicated if you're not familiar with the terms. Okay. Well, no, it's not that these guys are going long. What I'm saying is whoever shorted probably isn't just going to stop and reverse and go long now. For an institutional investor, their timelines are years. Their time horizon, their investment horizon, their risk horizon, right? An insurance company has a time horizon of 30 years, not 30 hours, right? Right. Sony USA sending money back to Sony Japan isn't also, I mean, I don't know. So they're large institutional companies, most of them are hedging or some sort of thing, right? But anyways, so all I'm saying is whoever shorted isn't probably instantly going long. All right, so let's talk about what actually happens. Let me clear this out. Let's zoom in a little bit. Okay, so why do these green candles appear? Is it people going long? See, by law, it's not people going long. Okay? So I don't want you to think of it, whoever drove it down is going to turn around and drive it up. I want you to think of it as exchanging positions. You see, we need to work together, you know, the bulls and bears. The people that lose money, Richards, right? The people that lose money are the ones trading between the bulls and bears. Professional bulls make money almost all the time. Professional bears make money almost all the time. That's why you have institutional traders, like let's say hedge funds, that are making huge amounts of money because they're selling where bears sell. They're buying where bulls buy, but they're actually working for clients that have certain needs and all that kind of stuff. So you can have you can almost separate them, like this is a bearish fund, that's a bullish fund. It's not really, but you can think of it that way. And what we're doing is working together. Bulls and bears are working together to say, all right, you sell here, it'll fall down to this place. You take profit, and I'll take you out of your position. And then I'll buy it, and I'll drive it up to the next level of resistance, and then you buy me out of my position. Okay? It's kind of like that. They're sort of working together. And then there's the amateurs that don't know what's going on, of course, and they're doing stuff here where others are kind of, let's say, doing it here, and they're doing it up here, and there's nothing in the middle for them. There's no market makers anymore. Come on. Okay. If you go back 30 years ago, Manny, there was a guy at your bank. You're at JP Morgan. You're a big multinational corporation, and JP Morgan is your banker, right? So you call up your banker and you're like, I have $1 billion in Polish zloty I'd like to dump. And I need to exchange it for dollars. $1 billion in Polish zloty. So what does JP Morgan say to this client that has, even in Polish zloty, has $1 billion? Let's say it's Nike or something, right? So Nike's like, yeah, give me some dollars. What does JP Morgan say to this client? Type a question mark if you don't know what I'm talking about. What does JP Morgan tell their client when he says, I want to dump $1 billion US dollars worth of zloty, which could be, I don't know, 10 billion, 20 billion, 100 billion zloty? They're like, sir, yes, sir. There probably isn't a market. There isn't someone sitting around like, yeah, you know what I need right now? I could really use 100 billion zloty. Like, I think I'll call up JP Morgan and say, hey guys, I'd like 100 billion zloty. I have $1 billion US dollars, and I'm like, I'm sick of holding this US dollar crap, and I need zloty, right? Right. So JP Morgan says to the client, you bet. Anything for you, Nike. And they do the swap. And then, JP Morgan gets on the phone and starts convincing every person they've ever met that they need to buy their zloty back from JP Morgan. They made the market. Okay? Now, the foreign exchange market is $6 trillion a day. There's really, it's so efficient, and there's so many players, and every bank on the planet is attached, right? And every broker is attached. I mean, with retail, and I mean, who's not attached to the interbanking system, right? 50 years ago or 100 years ago, I don't know, 50 years ago, you only had like the biggest of banks. New York City was basically it, attached to the interbanking system. Then they would call Europe. And if that didn't work, you stayed up all night and then you called Asia. But even calling Japan was like, wow, like crazy. I mean, 50 years ago, you probably didn't even call Japan. So I'm only talking 30 years ago now. Call up Japan, hey, can you do this, right? But now every bank and every financial institution and every corporation, even small corporations, even farmers are probably all attached through like TradersWay, for example, to the interbanking system, and now you're just, right? When I had family visiting from Australia, they're sitting on their phone. I'm like, what are you doing? They're like, we're watching the Aussie dollar. We're going to move some money. We're just watching it minute by minute. Like, dude, you're doing like my freaking job, right? Like, people are so connected now that you don't need a market maker. You don't need JP Morgan to make some calls for you. Just go, right? No, it cannot be random, Alan. And is it manipulated? Well, of course it's manipulated. Are you saying like I always laugh when I only hear it from the United States, but the United States says, China, you bad. You manipulate. You manipulate your currency. And at the same time, the Fed was buying like $200 billion a month of their own debt by printing money. You're like, wait, that's currency manipulation. You're making money That sounds a lot like currency manipulation, right? So it's just funny, like that is what central banks do, right? No, Manny. I think when they say market makers, they're talking about the stock market, right? Where you got to move, a million shares of Tesla for $150 a share or above. You need someone to work the phones for you. So an investment bank would say, you know, just give it to us. We'll take it. Here's your cash. We'll pay you 150 because it's selling $1.60, right? 160 bucks, right? So like, you know what? Boom. We'll give you the 150. Boom. Here's all your money, and we'll get on the phones and we'll hack this out. But they're going to make the spread, right? They're going to make 10 to 15 bucks a share, dumping this to their own clientele. They're making that market. But to a $6 trillion a day market, what are you moving where you can't find liquidity? Okay, maybe a very small African country. Right? Maybe a really troubled country, but I don't know, $1 billion, and you're like, buy me some British pound? All right. Filled. Want to buy something else? I'd like 2 billion in Swiss franc. Okay, got it. Ready? Filled. You don't need a market maker. Right? Well, the problem is Zimbabwe. By the time you press your button and 3 seconds later it fills, it's moved. You've been slipped. And you're like, oh, I just lost $1 million. Well, because it was falling so fast. But anyways. So the thing is, guys, let's change the tone of the conversation of, is it manipulated? Are there market makers in control of everything? Whoa. So for whatever, whoever's talking to you, stop listening to them. That's my humble opinion. I don't know who you're talking to. I don't know who you're listening to. Get new friends. Then second of all, the interesting thing is if you can pay attention to the data, you can understand why the central banks have the policies that they have. You don't have to be a rocket surgeon. In fact, they'll even tell you, if you know how to listen, they'll tell you what they're doing. So yes, they do manipulate. Good, get filthy, stinking rich off their manipulation. When the Fed says we're going to do quantitative easing and spend trillions of US dollars propping up the housing market and propping up the stock market, good. I was begging people. I'm like, look, they're printing money. They're giving it out. If you go back, when the stock market was going up and up and up and up, 8,000, 9,000, 10,000, 11,000, 12,000, 13,000, 14,000, 15,000, 16,000. I called it the free money rally. I said, why do you think the stock market's going up? The Fed is printing money, pumping it into the economy. It's free freaking money. Trillions of dollars. Just pick it up. What are you waiting for? And why are they doing this? They want the stock market to go up. They want the housing market to go up. So buy some shit. It's free. Buy as much as you possibly can. Free interest rates, free money. Buy a whole bunch of assets, not TVs and cars. The idiot with the yellow Lamborghini. What a moron. Buy assets. Buy assets because quantitative easing increases asset prices, free money. That's how it trickles down. Walmart just had the best quarter in 10 years. Why? Because it's finally trickled down to the average person, because they have a decent job now and they're getting decently paid and they feel decently confident about the near future, and all of that is great. But meanwhile, rich people got filthy, stinking, unbelievably rich. Why? The market was manipulated. And they knew it. I mean, it was designed to make people rich. So people that knew these things got rich. But that's what's supposed to happen, right? Yes, the market is manipulated. Thank you for manipulating it. It makes the TV on my wall half price. Awesome, because now I can get a bigger TV. Right? Right, Alan's like, I agree. Cool, right? Now I watch TV. I don't even watch TV, but it's great. 150-inch 4K. It's so funny. You walk in and you're like, holy. I'm like, thank you, China. Thank you, China. Thank you, China. It's amazing what a few $1,000 will buy you. Holy crap. Oh, you have to sit, I'm not joking, 18 feet away to watch the TV. This ain't far enough. Right? So thank you, China. Thank you, People's Bank of China, for manipulating the currency and making me richer. Because if $1 buys $1.50 worth of stuff, I'm 50% richer. My income hasn't changed, but my purchasing power has. And that inflation, because for me it's deflation, things are getting cheaper and cheaper and cheaper, and it's so awesome. Why? Because the money I spent, I bought assets with, and my government manipulated the market to make me richer. And then some other government on the other side of the world manipulates their currency to make me even richer. And I'm like, freaking A, this is awesome. Because now I can get this for cheap. But I didn't spend my money. I spent my money made me money, and I spent that money to buy money, and then they made it cheaper, and I get more for my money. Right? So that's what it's all about. So yes, the market's manipulated. If you understand it, you can make money on your charts, and you can make money in your life. And thank goodness it's manipulated. Okay? But think of it that way. The Bank of Japan and the Bank of China and several other banks work very, very, very hard to increase my wealth, my purchasing power. That's what they do all day, every day. How can I improve Wayne's purchasing power of our stuff? And then I have my government sitting around all day, every day thinking, how can I improve Wayne's purchasing power? How can I make that dude richer? And if you put it all together, it's a beautiful formula. And everyone else just shops at Walmart. And it's really good because Walmart's like super awesome, but whoever owns Walmart stock just made money today. They didn't even get out of bed. Congratulations. The stock price is up 8% today. Why? Because poor people are going to Walmart like crazy. They finally got a dead-end job, paying a half-decent crappy salary with crappy benefits. And they go, they buy crap for cheap. Thank you, China. At Walmart, Walmart sales are way up, and rich people that never stepped inside of a Walmart just got even richer, and they didn't even go to work. Right? But why? They own an asset. They owned Walmart stock, and they probably bought it back in 2009. And then it went up 50%, then it went up 50%, then it went up 50%, then it went up 50%. And this morning, best earnings in 10 years, stock market's up 8% today. That means the $1,000 turned into $1,500, and then it turned into $2,700, and then it turned into $3,300, and then it turned to $3,800, and now it's up 10%, so it's now $4,200. Their $1,000 is now worth $4,200, and they didn't get out of bed. But that was all by design, right? See? So we can learn how the system works. It's very Newtonian, meaning it's very mechanical. This cog fits into that cog, fits into that cog, fits into that cog. So you can figure that out. And then when you grow your money in Forex and grow your account big, don't spend it on yellow Lamborghinis. Certainly don't buy a boat, right? Buy an asset that makes you wealthier. Buy a house that increases the value 5% or more per year. Right? Buy a small business. Buy the stock market. Have a retirement account that owns things like Walmart that goes up 8% in a day. But it's not just Walmart. Across the street is Home Depot. Right? Home Depot was cheap, guys. They were talking about, like, first of all, people didn't have money. They were walking away from their houses because they couldn't afford to pay. There were empty houses everywhere, and half of those were brand new. So people were like, why would anybody want to go to Home Depot, right? And then finally, we got to a point where why would you buy an existing house, which probably needs to be fixed up, when you could buy a brand new house for 50% off? So that, once again, people said, why would you ever buy a Home Depot? Why would you fix up your own house? I can buy this brand new house for nothing. And there were thousands of them, entire empty neighborhoods. You'd buy the house, and somebody stole all the doorknobs, and there's no appliances, and even the toilet's gone. They're like, what? It's weird, brand new house and no toilet? So you start going to Home Depot. Eventually, all those deals are gone, and then all you had left was existing homes, but they were in rough shape. People hadn't invested in them for 5 or 6 years because they were broke and they're underwater in their mortgage and all that kind of stuff. They lost their job. So, like, my buddy, he bought, like, in my city, he bought like 8 houses. Then he put new electrical and new plumbing and new carpet and new paint and new windows and new roofs and new landscaping and new driveways. Every freaking house. A lot of that was Home Depot, man. Unbelievable, right? And that's how that, all of a sudden, you get those guys into the market, and then people started getting their jobs back, and then they were buying houses. Now housing prices are up. You can't even find inventory to buy, and Home Depot's through the roof. But there was a time when people were talking you out of it. But if you can only think 5 years ahead, 10 years ahead, you really thought Home Depot was going to go out of business? You really thought Starbucks? Starbucks dropped to, like, what was it, $3? You're like, well, that's it. No one's going to drink coffee anymore. I remember I'm at Starbucks with my wife. We're getting our lattes. And I said, honey, did you know Starbucks is at $3 today? She's like, really? I said, do you think people are going to stop drinking coffee because it's the end of capitalism as we know it? She's like, no, people love coffee. I'm like, yeah, I agree with that. You think Starbucks is going to be around in 15 years? She's like, yeah. I'm like, yeah, me too. All right? Buy the stock. Delta Airlines, $5. It's 75 now. Bank of America, $5. I mean, come on, like. So I gave all these speeches about Delta, about Starbucks, about Bank of America. I even told people the day I bought it at $5. But the point is, all of this is managed on the long run by central banks. Do they manipulate the market? It's the whole point of a central bank. When the economy is too hot, if you will, they cool it down. When it's too cool, they warm it up. How? By manipulation of the money supply. It's all in the fundamentals course, by the way. So if you understand that, which is called education, you can make money. And you don't need all these charts for that, because the timing of that is 10 years. Can you think 10 years ahead? Because 10 years ago, if you said, I think Home Depot is going to be around in 10 years, then you should buy it. Did you know Ford was paying 10% on a bond? Ford was paying 10% on a bond. So I gave a speech, and I don't know if you guys remember this. At the same time, you could buy a truck, 0 down, 0% financing. So I did the math and all that kind of stuff. And if you had bought, I think it was 3, maybe 4 of the trucks, you actually ended up getting 1 for free. And then, assuming you had the cash, right? And then you can go through that whole thing, dump all the trucks, and now you got your 1 free truck. We actually did that in a webinar. I proved it all out mathematically. That you ended up getting 1 truck for free. But Ford loved it because they could show they were selling lots of trucks. So they just sold 4 trucks. Oh, do you know how I got the truck for free? First of all, does anyone even remember it? I went through it for like 20 minutes on a conversation kind of like this on the Fundies. Peter remembers. So how did you get the truck for free? How long ago? 3 years, I'm guessing. Just go back to like, when was Ford paying a 10% bond, and when could you get a 0% interest loan on a vehicle? I think it came down to like, you could buy 4 trucks for $100,000, and you lent the $100,000 that you would have spent on the 4 trucks, you lend it to Ford by buying a $100,000 bond, which paid you $2,000 a year for 5 years, which is $50,000. Then they give you your $100,000 back. So now you get your now you have $150,000 in cash with the 4 trucks. So you see, like, so, well, that doesn't even work out, because then you end up getting 2 trucks for free. So yeah, so I did different numbers. So it wasn't 100,000. I'm like, okay, you have 50,000 in cash, lend it to Ford and all that, whatever. So it was great. Yeah, but you don't compound bonds. It's just a coupon payment, right? And I guess you could reinvest, but it's not that easy in bonds and stuff. But anyways, yeah. So like, I'm teaching you guys money. I explained step by step how Ford, based on their financing, would give you an absolute total brand new truck for free. Because they will pay you 10% to loan them money, and then they would give you money for free. Do you understand that logic? You could give Ford $100,000 in cash. They promise to pay you back and pay you $10,000 a year, right? But they will also lend it back to you for free. You see the dichotomy? You lend it to them at 10%, they lend it back to you for free. How many times would you like to do that deal? That doesn't blow your mind? I explained this to my son over breakfast, 3 years ago. So he's like 8. He's 8. I'm like, let me teach you about money, son. Yeah, all day, every day, right? I give you 100,000. Even just think of that. I'll give you 100,000. You give me 150,000 back. Now, why would Ford pay you that kind of money? Because the stock market was doubling every year. You'd have to be an idiot to only accept 10% on your money. Let's do one currency and then we'll get out of here. So, yeah, we didn't do any technical analysis really today. A little bit, but not much. But I hope the money conversation. Yeah. I think I'm going to do it next Friday. So I'm really supposed to be sending out an email and invite you guys. I'm sorry I'm not a better salesperson or a marketer. You know, this is what I've been doing with my day. What do you think of my new textbook? Oh, maybe it's just that one page that's ugly. Yeah, you're right. Maybe it is just the one. Oh my God. Look how small it is. Oh, I touched something. Don't touch that. Isn't that crazy? Oh, how about this page? See? Ah, commercial real estate. Yes, I'm becoming a real estate developer, baby. I'm building a hotel. Oh, that's a big boy book. Welcome to grad school, huh? Only 1,000 pages of that. Like, oh my God. So anyways, USD CAD. Somebody asked for USD CAD. All right, if you're a bear, this is a sell zone. If you're a bull, that was a bull zone. What's next? See, if you're a bear, if it goes any higher than it is now, stop selling. It's really that complicated, right? If you're a bear, you're supposed to sell in here. And if it goes any higher than that, stop selling. Okay, if you're a bull, you were supposed to buy it in this area. Okay. So now we're talking monthlies. So let's fold it back into the conversation we had earlier. The monthly trade plan for a bull is buy it at this price. Not this one, 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 not this one. This price. Okay? That's where bulls buy. And we're going here. And I'm saying long, I'm saying bull because Brooke says he's long. Great. Now let's fold this into a weekly trade plan. Okay? If I was a bull and I thought we were going to 133, see, that goes, if you were on TV, you'd say, well, we're bullish on the USD CAD with a target of 133. And, right? So we're buyers now at this level. Call it 130. Wow, really? Cool. So we're buyers at 130 with the target of 133. You should be able to reach that before September. Wow, that's some really complicated stuff. This is the actual entry for the week. This is the actual entry for the month. They collide. Perfect. There's your Arctic turtle sticking its neck out. Great. So anyone buying in this blue zone here for the week now, just the week, even though the month we're supposed to go up here, that's just the strategy. Now, tactically, it should go up to about here and then retrace to a role reversal, which is this one, which I've already drawn for you, which is here, in which a bull would buy it a second time. It's called price action. Okay, cool. Now, the interesting thing about that is if you caught it on Friday, you also know it's a front run. Sweet. So it opens out of position. So what do you say to yourself? You're like, well, first of all, this is the price where bears want to sell. Second of all, I'm out of position and it's going to retrace back to the 4-hour 21, which is here. Well, it went a little farther than that. Well, I'm sorry, dude. It opened up right at M3. What do you think is going to happen when you hit a weekly M3 and a monthly M3? It's the most obvious place a bear is going to sell that there is. So you could say, ooh, maybe I take profit on this one and I'll get the dip. No, what do you mean get the dip? Well, you already know you're out of position and it's going to come back to the 21. You already know that. So you're like, well, maybe I bag some profit here, buy the dip. Where's the dip going to be? Well, you're thinking 21. You're also thinking roll reversal, right? And you'll probably fib this to this. So, you know, it's not ideal. It's not ideal. It's not a great trade. It's not ideal. But it's what you would have been thinking about on Monday. So if you took your profit and you're going to start over again, on a weekly basis, where would you like to buy? Well, you would have said, well, I'm a buyer around 31 to 31.80, which is here. But you'll keep buying as low as 130.50. Why? Because that's the bullish zone on a weekly basis. The same that this was a bullish zone on a weekly basis. So you buy it here, right? And this is your aggressive target. And then you could buy this, and this is your aggressive target. This is your conservative target. So what you're thinking about now, what is it, Thursday? So a bull is thinking up, up, and done for the week. Is that it for the month? Well, this is obvious support, or sorry, obvious resistance. I'm pretty sure that's going to hold for some time frame. So a really aggressive bull thinks we're going to break that, but should know that it needs to come all the way back down to here and then maybe head up. This is why you should probably take your profit and then sit around the campfire waiting for the sun to rise, and then maybe consider doing it again, because ultimately you should be going to 33. But what if it only went to 32.80? Would you be satisfied? You're like, wow, it's supposed to go to 133. But I got it to 132.80, which is a cluster of a double top and a weekly R2. Do you want to stick around for? I say take the money and run. And it better be good, the entry here, because I'd rather buy it at 31.50 going for 33. So I'd rather start again and go for 150 pips than stick around, risk 130 pips to pick up the remaining 20. You see what I mean? Now here's the thing. Just food for thought. When somebody asks me, what about USD CAD, and I open up this, I see that in about 1 second. One second worth of analysis. There it is. Now, if bulls return, or sorry, if bears return, we will know because they have to sell it here. They have to. And if that's the case, I already have that analysis done for you here. Look, we did this 2 weeks ago. So when somebody says, well, what about USD CAD? I'm like, well, nothing's happened. It's still the sell zone from 2 weeks ago. But if it goes higher, holy smokes. Well, you say, well, Wayne, you're supposed to tell me whether it's going to go up or down. Well, I don't know if it's going to go up or down. But I explained clearly if you're a bull, this is where you buy. And I explained clearly if you're a bear, this is where you sell. And nothing's changed. So anyone bought it here, and anyone bought it here, and anyone bought it here is simply doing their job. And yeah, guess what? They're hell bent to get here. Right? And if I were me, which I've already done, I would mark this, and I would mark this, and I'd say this is an important resistance zone to me. And then I look at the pivots and I see this, and this, and this, and this, right? And the overlap is here. So really, this could get to 133 to 1.333. I was going to say 50, but whatever. We're going to maximum get here. But you know what? If I got to take profit here and take a week off, I'd recommend that. The question for whoever longed it here and here and here, I guess it's Brooke, do you go for it and hope this breaks? Or just play it like any other trade, get out, reset. Yeah. All right, so peace on earth, may the pips with you. May your profits be above average. Please visit TradersWay.com, open an account. If you're talking to support, say, hey, Wayne says hi. Let them know that you love these webinars, huh? Never hurts. Thank you very much, team. I'll see you tomorrow.